Everyone, welcome to my channel. Today I'm going to be updating about my stock account. Right now my stock account has made a loss of $2,137. PPI again confirms inflation cooling. US stocks close higher on Thursday. Under the triple challenge, G7 central bank difficult walk tightrope. The road to tightening is not over. US stocks closed higher on Thursday, with the Nasdaq up 2% and S&P 500 at its highest close since February. The US PPI rose 2.7% in March from a year earlier, the eighth straight month of decline, further confirming curve cooling US inflation. In my account today's PL, including the post-market, is a loss of 3.03%. Right now, the net asset of my account is $70,000. Today, the Unity software rose for 1.94% as a rebound from yesterday, right? Because of the rise in the S&P 500 and Nasdaq today, SQQQ and SPXU decreased for more than almost 2% today, with a total loss of $1,200, almost $1,300. Today's market closed high generally. The tech industries showed a rebound from this week's drops, and Dow Jones Industrial Average rose for 1.14% today. Nasdaq Composite rose for 1.99%, and S&P 500 rose for 1.33%. Out of the industries, consumer electronics and the internet retail rose the most, with a gain of more than 30%. In technology, stocks led the gains, leading by the tech communication services and information technology sector in the S&P 500. On Thursday, the Labor Department reported that the U.S. Producer Price Index fell 0.5% in March from the previous month, compared with market expectations of a flat reading. The PPI is a measure of the price companies pay, and is often the leading indicator of consumer inflation. Excluding foods and energy, the core PPI fell 0.1% month-on-month, far better than 0.2% gain expected by economists polled by Dow Jones. Another data put initial claims last week at 239,000, compared with 235,000 estimated and 228,000 previously. The PPI data confirms the slowing inflation trend reflected in Wednesday's March Consumer Price Index report. The Consumer Price Index rose 0.1% month-on-month and 5% year-on-year on March, released on Wednesday, indicating a slowdown in overall inflationary pressure in the past months. The CPI data briefly pushed the U.S. stocks higher. Spotting Rock asset management analyst Rhys Williams said, "The market seems to be able to rise on any good news, and in this case, the much better than expected PPI figure is the factor driving today's rally. I think the PPI data gives people some comfort because this data suggests that, in fact, the Fed may not have to raise interest rates at its next meeting." Verdant's capital advisors Megan Hornman said, "On optimism, the market may be a bit ahead of its curve and may leave the Fed will be able to cut rates at the market has priced. I don't think the Fed can do that. I think the Fed will have to keep monetary policy unchanged for longer than people expected, and then it's not likely to cut rates until next year. I think they'll have to stay put because we are still in a very tricky inflation environment." Markets continue to assess the risk of a U.S. recession. The minutes of the Fed's March Federal Open Market Committee meeting released on Wednesday warns that the Fed expects the most recent banking crisis to lead a recession later this year. Mr. Ed Moya, senior market analyst at ONDA, said Wall Street has shifted from modest inflation reports to the Fed minutes, which raised concerns about the recession. With banking earnings approaching, the banking sector may be facing a new round of turmoil. A wave of aggressive interest rates not seen in decades drawn to an end, but central banks have become more intertwined, with excessive interest rates leading to recession and financial risk, and the risk of runaway inflation. On April 12th, the Bank of Canada left its benchmark interest rate unchanged at 4.5%, but continued to shrink its balance sheet and maintain tight monetary policy. Meanwhile, the Bank of Canada also said it prepared to raise interest rates if necessary to meet its 2% inflation target, suggesting a resumption in the future. Similarly, with three challenges of fighting inflation, stabilizing the economy, and preventing financial risks, the Fed is likely to raise interest rates again, and the next enter wait-and-see mode, and the European Central Bank and the Bank of England will face worse inflation problems and face more difficult choices. Under the influence of the European and American banking crisis and other factors, the Bank of Japan will still maintain the ultra-loose monetary policy for the time being, and may normalize the monetary policy at the right time. As a so-called difficult economy, the G7 central bank will face more difficult choices from all the signs, except for the Pigeon King, Bank of Japan. Most of the G7 central banks will only be marginal to slow the pace of tightening. Even if the Bank of Canada G7 central bank suspends the first shot, it's still shrinking the balance sheet. The market expectations of easing policy is far from coming. The Bank of Canada has raised interest rates by 425 basis points since last March, and one of the most aggressive tightening cycles in history. In April 2022, Canada became the first country in the G7 to raise interest rates by 50 basis points, and the July meeting was even 100 basis points, the only G7 country to violently raise interest rates by 100 basis points. But in the face of economic pressures from aggressive rate hikes, the Bank of Canada took the first shot in March and the G7 to suspend rate hikes. However, the pause does not mean the end of tightening. The Bank of Canada said it will still assess the restrictive extent of interest rates and will raise rates further again if needed. Similarly, with three challenges of fighting inflation, stabilizing the economy, and preventing financial risks, the Fed is likely to raise interest rates again, and the The Bank of Canada suspended raising interest rates, but said it will raise again if necessary, in order to better guide market expectations and behavior. The pause is due to financial and economic stability, while keeping the possibility of another rate hike is designed to avoid the weakening if the effect of previous rate increases on curbing inflation. On the one hand, the Bank of Canada said it will continue to shrink its balance sheet and tighten market liquidity. On the other hand, the Bank of Canada also sent a relatively tight policy to signal that it will continue to raise interest rates if necessary. If inflation falls less than expected, in one's view, this is actually reflects the contradictory psychological and difficult situation of the Bank of Canada, with the trade-off between achieving soft landing and stabilizing prices. On the inflation side, Canadian inflation fell to 5.2% in February. For the future, the Bank of Canada expects inflation to fall quickly to around 3% by the middle of the year, and slowly meets its inflation target by the end of the next year. Like the Fed, the Bank of Canada stressed that it was unlikely to cut rates this year. Bank of Canada Governor John McCallum said the MPC discussed the need to keep interest rates high for a longer period of time. Market expects the Bank of Canada to cut rates later this year, but in McCallum's view, that is not the most likely scenario. The Bank of Canada is not alone in the G7 central banks. Developed countries are generally facing with three difficult choices to fight inflation, stabilize the economy, and prevent risks. Luca Pallini, chief strategist at the Best Asset Management, told 21st Century Business Herald that the economic turmoil will cause the banking storm in Europe and the United States to soon emerge. Global GDP growth will slow over the rest of the year amidst its long-term potential. The banking crisis will weigh on the growth in the medium term, with the GDP growth in advanced economies likely to slow to 1% in this year from 2% last year. 2.7% last year. In the U.S., recent financial turmoil is prompting small and medium-sized banks to tighten lending standards, which in turn can put pressure on consumer business investment. The question now, according to Mr. Liu, is how resilient consumer and business sentiment can show amid the aftershocks of the banking crisis. Even officials are no longer hide the possibility of a recession, with the Fed predicting that the recession may begin later this year due to pressure from the banking sector, and the upward trend of unemployment will continue until early 2024. After assessing the economic environment, the Fed may raise interest rates by 25 basis points at its final meeting on May 3rd. Former Treasury Secretary Sam Summers said that the Federal Reserve is nearing the end of a rate hike cycle. The outlook for Europe is not very optimistic either. European banks as a whole have ample capital and liquidity cushion, and the region's financial sector may perform better than the US financial sector. Still, credit conditions are expected to become even tighter as the ECB raise interest rates to contain stubborn price pressures, which will weigh on risky assets. The ECB raised interest rates by 50 basis points in March despite banking storms in Europe and Switzerland, but did not give guidance for May. But the sentiment March inflation data adds to the reason for the ECB to tighten monetary policy further. Klaas Knot, a member of the ECB Central Committee and governor of Dutch Central Bank, says the ECB must continue to raise interest rates, though a slowdown in the pace may be reasonable. We certainly haven't finished raising interest rates yet, and the core inflation rate in the Eurozone is now close to 6%, and you can't fight inflation with 3% interest rates. Asked if the Fed would cut interest rates before the end of the year, Knot said that was almost impossible, even if our current interest rates are likely to bring inflation back to 2% in the medium term. We have kept interest rates high for a long time. The austerity is not over yet. Although the central banks are raising interest rates, it'll take some time to cut interest rates. The balance sheet reduction will continue. The money supply has fallen, and the tightening road is not coming to an end. On April 11th, the New York Fed released a report showing that the Fed will continue to shrink its balance sheet over the next few years. The Fed's current balance sheet, about $8.7 trillion, could fall about $6.6 trillion by mid-2025 and then hold steady for about a year. In addition to Federal Reserve, the European Central Bank, Bank of England, and others generally continue to shrink their balance sheet. In response, there has been generally a sharp decline in monetary policy in money supply in advanced economies. In the Eurozone, the 6-month rate of change in M3 broad money supply, which measures deposits and cash equivalents below 3 years, was the lowest since 2010, while the M1 narrow money supply fell to negative territory for the first time since Euro in 1999. Britain's M4 money supply growth also fallen well below the trend. The situation in the US is similar to that of in Europe, where M2 money supply growth fell at the end of the last year. British economist Simon Ward said the annual growth rate for broad money in places like the UK and the Eurozone was much lower than the 2010s average, which was very worrying and could signal the arrival of a recession, falling inflation, and even deflation. In addition, although regional inflation has generally fallen from the post-outbreak peak, it is still well above the 2% target, and the core CPI problem is much more severe, meaning that the road to tightening needs to continue. The CPI rose 5% in March from a year earlier, the lowest level since May 2021, according to the Bureau of Labor Statistics, but excluding volatile energy and food. Stubborn core inflation is troubling the Fed, with core CPI rising 5.6% in March from a year earlier, up from 5.5% in February, and economists see a better forecast of future inflation. Similarly, the Eurozone reconciliation of CPI rose 6.9% in March, down from 8.5% in February, according to Eurostat, but the core reconciliation CPI rose 5.7% in March from a year earlier, up from 5.6% in February and hitting a record high. ECB Commissioner Isabel Sanabel admits that the overall inflation has begun to fall, but core inflation remains tricky. Excluding fresh food prices, the core CPI rose 3.1% in February from 4.2% in January, for the first time in 13 months, after government energy subsidies came to work. But the super core CPI, which excludes fresh food and energy, grew 3.5% year-on-year, up from 3.2% in January and the highest 41-year pace. In his opinion, the G7 central banks are generally facing the problem of maintaining price stability or ensuring the economic or financial stability. For the same point, they are all facing the pressure of rising prices and insufficient effectiveness of monetary policy. And continuous sharp contraction of monetary policy has impacted economic growth and the stability of the financial system of various countries. The difference is that the inflation pressure falls sharply in the US and risk in the financial system gradually rise. Inflation pressures persist in the UK and Eurozone. Bank of Japan is controllable, but economic growth is a long week. Canadian inflation starts to fall and is expected to fall rapidly around 3% in mid-year. When said, different economies will face different pressure on economic growth, prices, and financial stability, and the pace of monetary policy will gradually divide. As for the Pigeon King of the G7 Central Bank, Wayne believes that the Bank of Japan's monetary policy formulation will give more consideration in the needs of its own economy. Even if there are some adjustments in the future, the range may not be very large, and it will be more moderate adjustment. That's all I have today. Thank you for listening. Don't forget to subscribe and like. See you next episode.